So one of the things is, how do you actually prepare for this? We've now got just over 2 years excuse me, for implementation. In fact, we don't have a date for 2010. We just assume at the moment, for the sake of it, that it'll be the 1st of July. So one of the things, as I said, most of the companies who are liable parties do understand their inventory quite well, but they've been reporting it through voluntary mechanisms like sustainability reports, and a number of issues have not had to be resolved. For example, the accuracy of the reporting. In some sectors, the accuracy is very, very poor, and it's not because the people don't know what they're doing. There simply hasn't been, for example, online measurement because they haven't needed to know it. And so you're able to put a little footnote to say, it's plus or minus 30, 40 or more percent. The carbon markets and the Australian regulator won't accept that, and so we have an issue over time as to how we improve that accuracy of measurement. The other thing is, as I said at the beginning, it's very difficult to understand what the impact will be going forward when you don't understand the design of the scheme, and therefore you have no clear view as to what the carbon price will be. Business is used to making decisions, though, in this sort of environment, and it will actually adapt. It's no different to knowing what the exchange rate is, or the cost of crude, or what interest rate will be. They're very variable, and I'm sure most people in the room will admit that if you looked at your forecast 5 years out, you're probably wrong on all of those factors, and we all will be wrong on the price of carbon going forward. But it's a matter of managing that risk and building the scenarios and understanding how you might be flexible enough to respond to those changes as they happen. The other thing is just to think about how you might continue to lobby with government and to write the submissions for the Garnaut review, for example. So if you are energy intensive or if you're trade exposed, how are you going to argue that argument? Why do you think you should get free permits? That's going to be one of the biggest issues of the next few months. And it's really important that we all understand what those justifications, if they're real, what they really are. And so I would suggest that having a look at some of the submissions is really worthwhile. The other thing is to understand from a business perspective what all your stakeholders are thinking. And for most of the large businesses we're talking about, they're also international companies, and so therefore they've dealt with some of these issues in other countries. The proposed rollout for the emissions trading scheme in Australia has been clearly articulated in the last few days. So we have two separate processes, at least at the moment. The Garnaut review is now seen as reasonably independent from the government, but the key advisor. So Ross Garnaut will be releasing on Easter Thursday his paper on emissions trading. He's delayed that by about a week, but it'll be out this Thursday. He's also presenting at a CEDA event in Sydney, and so he'll be articulating his views at that particular venue in terms of emissions trading. He's extended the date for submissions to the 18th of April for the emissions trading discussion paper only. And as we know, he'll have a draft but final paper out in July, and then he'll take comments and submissions on that and have the final paper prepared for September. In parallel with that, the Department of Climate Change has said that between now and June, they'll be continuing their consultation, they'll be ramping it up, they'll be looking at technical issues with government and industry, all the really nitty-gritty that nobody's really sat down and thought about, but now we don't have time to let this go any longer. So the good news is in July this year, we'll have a green paper. It'll be a key piece of work for us to actually all sit and look at and decide whether we like the option or not, how are we going to respond to that, and they've said that they're very open to consultation. So what we're looking at then in December is the exposure draft legislation. That's obviously a fairly critical milestone, and so everyone will be able to understand what that looks like. And then it continues to go forward right through to the beginning of the emissions trading scheme in 2010. But as we said, we don't have a date. We're assuming it's the 1st of July. Just want to finish with a couple of slides to talk about what the carbon market really is. As I said, last year it was 60 billion US, and that was just known trades. It's a market, and that was in a period where the EU scheme had allowances trading at cents, not even euro dollars, not even euros. It was in the cents range, whereas today it's trading about 21 euros. So we expect that this year, of course, will be a significant lift to that $60 billion. One thing we've seen is a tremendous shift here, where there was previously the World Bank and a number of European governments involved. Now we're seeing a lot of the carbon funds are dominated by the capital markets, by the investment banks, for example. And we all in that market therefore have a vested interest in this continuing, even in the very uncertain times that we don't know what happens after 2012 because there's no international regime. These markets expect it will continue. This slide just gives you some idea of the growing investment from different banks. So Climate Change Capital is a boutique bank based in London, developed simply for this market, and we all thought $1 billion sounded like a lot. They were oversubscribed quite quickly, and we're looking at the other, particularly the American banks, which is interesting in itself that the American banks are so actively involved in growing this market. They're starting to talk about longer timeframes and wider disbursement of their investment, but they're simply getting up to numbers like $50 billion, so it's huge. And this slide just gives you some idea of the current pricing and the trends. So we're talking about EU allowances under the emissions trading scheme in the EU of about 21 euros, and the CERs are the certified emission reduction units that come from the CDM projects. They're interesting that they're trading obviously below that because there's a cap on CERs into the European scheme, so there is artificially a price differential there. But interestingly for me, the US is prepared to pay $24 for a CER. So gone are the days where we thought we were just importing cheap credits from Asia. This is not going to be the case. And also the other point to make is the huge differential between the mandatory market and the voluntary market. So we're still looking at around about the 4 euros or 5.50 US for the voluntary market. And the trend is largely up, but as I said, one of the things is in this market is that they won't always just trend up. If you change the regulation, for example, if you allow more eligible technologies into the CER market, in fact, you could swamp it and the price could come down. So in terms of the outlook for markets like the CDM, it's important, as I said, because it's one of those linking activities between other international schemes, is that we're looking at huge potential markets going forward, driven by very deep cuts out to 2020 and even deeper, of course, out to 2050. What will change the dynamics of the carbon price over this period, the supply and demand, of course, will also be dictated by new technologies coming forward. And if you think back 20 or 30 years, we have technologies today that were never conceived of in that time frame. So if you look forward, there's no doubt there will be some sort of a technological breakthrough that will in fact be delivered at reasonable cost, and in fact the value of a CER or any other carbon commodity could plummet over that time. So you have to be fairly brave in terms of participating in this market, but most Australian companies have no choice anymore. They will be part of it. And therefore my last slide is that there are going to be winners and losers, and this is all about getting prepared, being flexible, understanding what the risks are, and I think from my experience it's going out and playing in the market. One of the good things I found at Origin is just, and particularly people like Grant King, the Managing Director, is just allowing the staff to get involved, to learn from the current regulatory markets and actually to go and play. So it doesn't cost very much to go and buy some CERs, to actually work out how difficult it is to put it on a UK registry, understand the risks of getting it off that registry, for example, or even in the voluntary market, as you've done for the conference, understand what it's like to actually go and trade. Most Australian companies have got no capacity whatsoever at the moment for carbon trading. They have no internal controls, they haven't thought it through yet. So there's an enormous amount of work to be done in the next couple of years, and I think it's learning by doing. So I'd leave you with my comment that I think it's a huge challenge. We're waiting for the regulatory decision making, and it's up to us to also input into that process. Thank you.
Thanks, Lorraine. Actually, I can relate to that comment about the voluntary carbon markets because I was involved in purchasing the offsets for CMSF, and it proved to be really quite a difficult and involved process, both in assessing the particular offsets that were on offer and then also in actually the mechanics of buying them. We've got some time for questions, so if you could, okay.
Just over here, thanks. Tim Ferrari from Host Plus. You mentioned, I think, that the banks seem to be the ones that are buying the CERs. If the banks are also the ones who are investing in new technologies and probably owning those technologies and have the capacity to restrict those new technologies entering the market to reduce the price of the CERs they've bought, are we looking at the situation like the oil industry and the technology and doing the same things again with banks being the primary restrictor of new technologies coming in?
I think that's a risk. What we're seeing at the moment is as I said, a very active participation in the carbon market itself, and you're right, some investment in the technology too. I think it's important that those in industry that have a vested interest in the technology also have a stake in it, and so therefore it is something that's going to be distributed more widely. One of the real challenges is that most people, on a global level, we want the technology to be taken up by all the developing countries, which means that it needs to be low cost and it needs to be at good scale. As you said, the challenge really is those conflicting interests between keeping the price up and getting a return on those investments versus getting that outcome. There's been some effort in terms of just the design of auctions, for example, to make sure there's not market power coming into play, and that would be another consideration in Australia. But how you actually fix the overall consideration, the balance between the dissemination of new technology versus keeping the price up, I don't have an answer to that.
One up here.
Paul Newland from Merrill Lynch. I just had a fairly high level couple of questions really. One relates to the existing assets, I suppose, if you segment the problem here into sort of existing assets around sort of generation assets, resources companies, tourism, things like that, and then you look forward and you say, okay, there's all this money available to go into new areas, if you like. There's some fairly large figures that you mentioned there. As the carbon trading system comes into place, how long do you see the risks and opportunities sort of playing out relating to the existing assets? So we're looking at a trading system in 2010. How long do you sort of see that taking to play out? And then secondly, I suppose when we look even further forward, as all this money is going into new technologies, what are some of the assets and ideas that are out there? I think I heard an interesting one the other day, was referred to as eco-securitization. And I guess that's monetisation of the existing rainforest. So an interesting idea. But I was just wondering if you'd give us a general view on how you see this playing out over the next five years or so.
Okay. The impact on the existing generators is largely to be determined by what the demand is going forward for electricity, for example. So one thing in Australia is that we do have the demand for significant new baseload generation, or at least large-scale investment, and you'd have to be incredibly brave to invest in existing technology today. So that's one of the reasons we haven't had a lot of new large-scale investment recently. So you're probably looking at a time frame out to about 2020 where the existing generators can continue to run, and if they get a reasonable upfront allocation, I think that's a consideration, and therefore we will probably be looking at the mid-2020s where we're getting a changeover from the current assets into new assets. But of course we can't, our system isn't designed for those current plants just to shut down. It takes at least 4 years for a new gas-fired plant, for example, to be built from scratch, and it's probably 5 or 6 for a coal-fired plant. And of course, you wouldn't be building a basic one, you'd have to be building a new technology plus probably carbon capture and storage, so it's even longer. So one of the dilemmas is this whole issue about how do we actually continue with the assets we have, but create the incentive for less emissions and new technology build over that time frame. The concern in the industry, of course, is one, and for investors, is one of stranded assets. And if there was no greenhouse issue at all, some of these plants would run for another 40 years. They've been designed to do that, they get upgraded. So I don't think it's something that will play out in 5 years. In my view, it's probably the early 2020s that we'll see that technology changeover, but it will depend on our demand. It might be simply new investment to keep up with the growing demand, and therefore we may end up in the position whereby it's very difficult to shut down that existing plant. It will definitely, though, be less profitable. So there becomes a point at which the owner of the asset says, enough's enough. If I've got some free permits, I might just close down. That's one other reason why in the proposal under the task group, if the generators were to get free permits, they were to keep them if they shut down, because that was a further incentive to either change technology or make an alternative investment in Australia. In terms of the international market, I think that the opportunities are incredibly diverse. If you look at the approved methodologies through the CDM Executive Board, they go from The most basic proposals, which are using new little cookers only about so big in villages, to right the way through to cleaner coal-fired power stations and all the things in between. So if you're building a renewables project, a wind farm or a small hydro, all of those get included. The broad base of energy efficiency, everything like that's included. I think it's an incredibly innovative scheme. We haven't seen a lot of new technology come through though in that. We've seen sort of cleaner than business as usual. So we haven't seen a lot of that come through. In Australia, we're still grappling with some of the renewable technologies. As I said, geothermal's been around for a while. Companies have made some significant investments, but it hasn't really sort of been proven anywhere near the scale that you'd want yet. We're starting to see some other technologies like wave being demonstrated at quite a small scale. And then in more broad terms, we're starting to see some of the innovation at the consumer end. So we're starting to see more at a distributed nature, so things like the solar PV panels or just smart meters and some of the smart electrical management within homes and buildings. Some of those sorts of things are starting to really pay dividends. But again, in Australia, because we haven't had any drivers for these sorts of changes, we're really only implementing those in new buildings. It's going to take some time unless we dramatically change the building code to get it adopted across the board.
Yes, over here.
Do you think that Bill Watson's statewide superannuation, do you think that there's a possibility that the carbon credits attached to agriculture and timberland will become so valuable that the primary purpose of both agriculture and timberland will be lost? So what I suppose the hypothesis is that trees will be more valuable on the stump rather than as saw log or as wood chips.
Well, it's certainly very possible because we're starting to look at some quite high prices of carbon. And also the way that the forestry projects will be managed is that often you've got to make a decision up front as to whether it's only for carbon or whether there's other timber values associated with it. And for example, this is not my area of expertise, but for example, Treasurer Costello last year announced new tax regulation, a preferential treatment if in fact you were to invest only for the carbon value. And you have to make that decision up front on the investment side. The other thing is, of course, that if you are looking for multiple values, including the timber, then you must account for the debit as well when you harvest the timber. And we're seeing some real issues there in New Zealand where it's just one of those unfortunate quirks in terms of the cycles, is that there are some major forestry activities that were planted, let's say 2 rotations ago, that are due for their final harvest. And if they have, and that would have been quite normal, it was all expected, it was a long time frame in terms of when they were first planted. The owners of those forestry assets, though, if they harvest today, they've got to pay all the carbon back. And it's got to a point where, in fact, they've said they'd rather break their contracts and pay their lawyers than actually pay the carbon, and they're just going to keep the trees. And it was compounded by the fact that this was going to be land that was going to be cleared for dairying activity for the export market. And so you would actually get a double whammy if you cut the trees down and you in fact had the dairying activity. And but economically that might have actually been a good outcome for New Zealand. So we do have some really unusual decisions coming forward which we haven't had to think about. And it's not the fault of anyone, because you wouldn't have thought about when you planted these trees that long ago that you would have had this looming liability in 2008. But that's one of the issues, and so that raises the other considerations then of monoculture and whether in fact it's good for the community, for example, because you don't have the same diversity that you had before. And perhaps one of the options I'm thinking about is that there is a growing voluntary market for things like biodiversity credits, and so it's about sort of building a broader range of values into the activity than just the carbon itself, and perhaps that means then that the community can benefit from that. But there's no simple answer to what happens with the debit from the harvesting of any trees in the forestry market.
Right over there.
Louise.
Sorry, Alan Stewart from TIS. Interested in the comment where it said that the MRET will be complemented. There's already an existing regulation, an act, which was brought in by the government in December 2000, that's created a product that's available to polluters, if I refer to them as that, in the market, known as a renewable energy certificate. Now, those renewable energy certificates can be purchased, and they're currently at a price of $40 a megawatt. My question is, has it been considered the effect of the CERs as against the RECs in the marketplace, which is available for currently available as against what might be available?
Okay. The MRET is also driven by regulation. It's one of those ones that the government really loves because they can implement the regulation and they don't have to pay for it. Initially the retailer does. So MRET is a liability for electricity retailers in Australia. According to their market share, they must surrender a certain number of RECs every year, and ultimately they pass that cost on to us. If you're thinking about, and you're right, it's gone back up to about the $40 a megawatt hour. If you're thinking about a liable party and under an emissions trading scheme, then it's possible that if there was a surplus of RECs, they could use those, in theory, to offset their liability. There's no fungibility at the moment, though, between the different carbon commodities in Australia, so that does create an issue, although you can invest in a renewable project under the CER, under the CDM, and earn CERs in another country. The challenge going forward is that what the new Rudd government set in opposition and will now implement is that because the target under that existing MRET wasn't increased, each of the states basically went away and did their own thing. And what the Australian government is doing is now bringing all of those state-based targets into a new aggregated, increased federal target, which is 45,000 gigawatt hours by 2020, which is a lot, by the way. So we do have an interesting policy dilemma that we have emissions trading, which puts a price on carbon and greenhouse gas emissions, but we also have a preferential policy which supports the investment in renewable energy. I think the challenge is because that's been set so high and it has to be met, otherwise the retailer pays the penalty, that there won't be any surplus RECs in the Australian marketplace out to 2020. So there's no additional supply that a liable party could use, and then you say that that's offset their emissions under the emissions trading scheme, if that makes sense. It's such a high requirement. And in fact, most of the people in the industry doing the modelling aren't quite sure where it's going to come from. But over time, there'll be more innovation and we'll find it. But it has to be satisfied first and foremost, otherwise the retailers are liable. And therefore, anyone else, another generator, for example, won't be able to take anything above and beyond that 45,000. Does that make sense? So, for example, it might be cheaper to go and build a wind farm in India than to think about doing it in Australia, because anything that gets built in Australia will come under the MRET.
Okay, we've got time for one last question. Up the top here.
Tony O'Grady, Health Industry Plan. Can carbon trading at all cater for the full environmental cost or impact of actually producing a product? You mentioned on a couple of occasions the use of massive amounts of water in electricity generation, for example. And I'm mindful that this conference is carbon neutral, yet we have bottled water. And I have read that it takes about 200 litres of water to produce a 600ml bottle of water. So even though we might offset the carbon in that plastic, what about the broader environmental impact?
Sure. No, emissions trading does not obviously offset all of the environmental issues, and it's also not designed to be life cycle analysis. So under the proposed emissions trading scheme in Australia, it will be the point source of the emission only, which is actually quite different to the voluntary schemes at the moment. So under the Australian, the old AGO, the Australian Greenhouse Office Greenhouse Friendly Program, I'm thinking of a couple of examples here. The most recent one was Cascade Beer. There's a gas, Origin has a natural gas product, and there's a couple of paint products. And BP have a fuel. So if you buy that product that has a greenhouse-friendly tag on it, the whole of the life cycle emissions are offset in terms of greenhouse gas emissions. But even that doesn't include water and any other air pollutants, for example, aren't captured. And so, no, we'd have to find more markets. What we are seeing, though, is a lot more activity in a voluntary sense for broader environmental commodities. So there are some new exchanges. There's the new FEX in Sydney, where you can go and actually buy, for example, a biodiversity credit. There's a couple of different, and these are defined by whoever wants to define them and bought by whoever wants to buy them. There's no regulation at all in place. But for example, if a farmer up in North Queensland does something innovative and it cuts the runoff to the barrier reef, then that potentially can be packaged as a product and somebody can go and buy it. So we are seeing a lot more of that sort of development, but it's not in the mandatory sense.
Okay, we'll have to leave it there for reasons of time. I'd like to thank Lorraine for a very informative and wide-ranging presentation on this issue. We have a gift provided by Bridgewater for Lorraine, which is actually an Oxfam voucher in an effort to reduce CMSF's carbon emissions. We decided to do that. Please join me in thanking Lorraine.